And now we'll hear from Mr. Sherman for 5 minutes.
Thank you, Mr. Chairman. Responding in part to the gentleman from Alabama, I think it's important not who pays the credit rating agency, but who selects the credit rating agency. And I'll give you a baseball analysis on that. Imagine a baseball league in which the league pays the umpires, but the home team gets to select anybody they want to be the umpire. That's going to be a home team that's going to win a lot of games. In contrast, imagine a baseball league where the home team has to give $100 to the umpire, each umpire, but the league sends out the umpires. Those are going to be umpires who are answerable to the league, whose livelihood depends upon the league thinking they're doing a good job. As long as issuers are selecting the credit rating agency, then the way to be successful as a credit rating agency is to make the issuers happy and then conceal from the public that the way to be successful is to make the issuers happy. It's who selects, not who pays. Now, one approach we could have to all this is to try to make the credit rating more reliable. The other, and I think our first witness kind of took this approach, I'm sure I'm oversimplifying, we could just tell everybody how unreliable these credit ratings are and tell them not to rely upon them or only as a first step. Now, Vanguard has the advantage of hiring, 30, 40 different credit analysts. I won't ask you whether it's 30 or 40. Investors ought to be allowed to invest directly in debt instruments without hiring a team of 40 people. They should be able to rely on the credit rating. And I've got all my money at Vanguard. So I'm relying on your analysts, but not entirely, because I have to compare your funds to other funds that tell me they get better yields. But then I look and I see which fund invests more safely. Well, how can I determine that? I could rely upon your name, although there's some big names on Wall Street that have tanked recently. I don't know which names are good and which aren't. Or I can rely upon the fact that your bond funds are mostly AA and partially AAA, and somebody else's high-yield fund. As a matter of fact, that's what distinguishes your high-yield fund from the lower-yield funds. Professor, you said if somebody gathers information, analyzes it, and expresses their opinion, that would be protected by the First Amendment. I would add that's what my doctor does. But, boy, if he's wrong, I'm going to sue him. But more to the point, that's what accountants do, and that's what legal opinions do in offering materials, private placement memorandums, SEC regulations. I think I'm the only CPA up here. And when you look in the offering materials, there are financial statements, and then there is 2 paragraphs usually written by the auditors. They say, in our opinion, the attached financial statements accurately reflect according to generally accepted accounting principles. So I'll ask you to respond for the record how the credit rating agency is different from the accounting firm, both in public offerings and in private placement memoranda. But also, you have, if there's a tax-advantaged investment, you usually have an opinion letter from a tax counsel saying, here are what the tax consequences are. I've been the auditor, I've been the tax counsel, and in every case I knew I'd get sued if I was wrong. Otherwise, my professionalism would have restrained me, but I've got colleagues that would have issued just about any kind of opinion. What I'll ask you to respond to orally, those other questions are for the rating, is there any constitutional bar to us saying certain credit rating agencies will register with the SEC, and as part of that registration, should they choose to register, they have to waive the right not to be sued for their negligence?
All right, before I answer, could I ask, what is it that they get out of the registration? Is it that they have to be registered in order to?
No,
rating?
anybody
They
can
get
register,
special-
but then the SEC would then says if you want to issue a debt instrument, you must get one of our registered SROs to rate you. But of course, you can go out and hire 12 other people. Even what was the cousin? Sheldon, and you could even get Sheldon, and you could. You got free speech. You could talk all you want about your offering, but you have to pick one from our panel if you want to sell.
Sure. Let me speak in order to both of the matters that you raised. The first is the status of professional client speech, and to what extent these rating agencies are the equivalent of a doctor or a lawyer or an accountant.
Well, in this
giving
case, they would
advice
be
to-
registered professional agencies. If you didn't want to be a professional, I see that Fitch is saying it's not a professional judgment, but the SEC would say you can't register unless you want to be a professional.
Got it. So somebody wants to go out there and convey their opinion and have other people pay for the opinion, they are free to do so. But if they want the special government imprimatur that allows an issuer of bonds to include that opinion as part of its issue, or I guess to issue it on reliance on that opinion, they have to comply with certain things. I try to speak to that in some measure in my prepared remarks, and I think that generally speaking, that would be constitutionally permissible. If going forward, the government were to say, as a condition of getting this particular special government benefit, we demand that you comply with certain kinds of accounting procedures, or that you not take any money from the organization that you are rating, or even that you agree to be liable under a negligence standard,
Okay.
then I think as a condition of
I've got to try to squeeze in one more question.
Sure.
That is, I'm going to propose that the SEC identify which credit rating agencies are qualified. In fact, they've already identified 10, but which are qualified for particular categories of debt instruments. And then every issuer, when they want to take an issue public of debt, they call the SEC, and the SEC assigns one at random, the same way the league assigns a team of umpires. Mr. Joint, this would mean that you would never have to please an issuer. As a matter of fact, if you regard it as a really tough rater, that might be fine because it would improve your image with the SEC. That would change your business model. It would allow perhaps other competitors to emerge, in that having a big name like your company does wouldn't matter as much as being rated as qualified by the SEC. Do you see, what disadvantage do you see to someone like myself who would like to invest $10,000 or $20,000 in debt instruments and get a rating that I can rely on?
I guess I would come back to try to understand the goal of diversifying that widely among market participants. From our personal interest, of course, we spent a lot of time building up our professionalism and our global reputation. I think we serve investors well as a global rating agency, able to rate a wide variety of things. If there was...
Well, you would be qualified for all the different categories, or maybe there should just be one or two categories.
So then the question turns to what I had mentioned earlier, which is on what basis would the SEC or anyone choose among the rating agencies? And if it was just a random sort of rotation, then I suppose that would be just adjusting the market shares of as many participants join this system is what it would be. So there would be, I think many people would try to join. There would be 20, 30, 50 different rating agencies that would certainly impact the business dynamics of the existing rating agencies, including...
But then I would get a rating from an agency that the SEC thought was qualified to do the job. That rating agency would be absolutely unaffected by the desires of the issuer.
But
What's not to like?
so I believe that we're unaffected by the desires of the issuer today, so that the difference between your statement and mine is that
Look, I've never been in your profession, but my doctor seems to care whether I'm pleased as a patient. When I was a lawyer, I wanted to please my clients. When I was a CPA, I wanted to please my clients. I want to please my constituents. You don't even claim to be a professional, but you claim a level of professionalism so high that you don't care about the business effects to your enterprise of what you do, and in particular, you don't care about whether you please the people who can decide whether to give you the next $1 million contract.
But our
So
credibility,
you're claiming a level of professionalism I never aspired to, while disclaiming being a professional.
so our credibility comes from building our reputation, not just with issuers, but with investors, regulators, and everyone over a long period of time. And so keeping the proper balance and being independent and doing a thorough job is very important.
I could have bought that last year, but now I've seen Alt-A get AAA, and I'm
not
not buying it.
unaware.
I'll yield back.